Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Wednesday, April 12, 2017. Looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. Just a quick reminder that tomorrow on Thursday will be the last session of the week in observance of Good Friday holiday on Friday. The markets are closed, therefore one more video this week on Thursday evening. Okay, into the action from today, and we got a reversal of what looked like a potential intraday reversal yesterday. So the market never ceases to amaze. It always makes it interesting, and it certainly is out to fool as many people as possible as much of the time. I can't stress that enough. Ever. Okay, so what we have today is an opening on top basically on the underside of the 50-period moving average, which is the blue upsloping trend line. And the market basically traded lower all day long with some, back and forth activity. But what this does is it pulls into question just where and when this low we're looking for is going to occur. And it will. This is the way markets make lows. It makes lows on terrible news like the geopolitics out there. It makes lows on increasing bearish sentiment. It makes lows on looking like it's going to do one thing and does the other. And it makes highs that way too, in the exact opposite in terms of sentiment. But this is the way it works. So we're looking for a low. But what's interesting are a couple of things. I said the other day that this is going to be an important pivot low to close above or below 233.91 from the 3rd of April. Today we closed above that, having dipped below it yesterday, closing above, having dipped below it today, closing above. That remains an important pivot. That doesn't mean the lows are in. That just means the market is fighting the urge to close below that pivot, which I think and I contend is an important pivot, certainly as evidence of the last 2 days and having the market rally to close above that level. So here's what I think is going on, and we'll know more whether it be tomorrow or into Monday. The market's closed on Friday, but we have a whole series of bank earnings tomorrow. So it's going to be a gap trading, for lack of a better term, earnings bonanza beginning tomorrow with the bank earnings. Now, if they're perceived as poor, the market can certainly take another leg down, and we'll get to where that would be in a second. And it could also potentially bleed over into Monday. So I think we're going to make a stand in one of two places. Remember this 232.34. I think that's going to come back into play potentially, maybe slightly higher, but that number seems to come up, or at a double bottom here. Now, if the double bottom doesn't hold, that comes in at 231.61. If that doesn't hold on a daily closing basis, intraday, they can pierce it, but if the market closes below that level on an intraday basis, then we go right down to 230, in my opinion, okay, with confirmation below. However, if we come down and test some of these lower levels, 232.34, 232.50, even double bottom, and we close above there and have a nice reversal during the day, whether it be Thursday or Monday, now that is something different. That may be the low we're looking for. It's possible, but that's on my mind. That's what I'm looking for. That's kind of my nice to have roadmap, and we'll call it a nice to have roadmap because the market never does exactly and precisely what we want. It does what it's going to do. Our job is to read it as best we can, and if I see that developing, my antennas will go up because I am looking for that possibility as one of the scenarios. Now, even one step further than that, how would you trade something like that if you're looking to get into, for example, a long SPDR trade or some other vehicle that tracks the S&P, options, triple, double ETF, a SPDR itself, anything like that? What would you do in that scenario? Well, what I would say is at those lows, if we played out that scenario where we did come down tomorrow or Monday and tested some of those lower levels, whether it be double bottom, 232.50, 232.34, that's where I would be willing to step into the market and take a position, even premature of a reversal signal. And here's the reason why. As long as I was willing to risk a close below the low from March 27th, which is at 231.61. If I'm willing to risk that happening, then I can step in near that low with a degree of certainty that that low is going to hold. It's not 100%, nothing is. It may not hold, and if it doesn't, I have to be willing to add to the position down at 230 if I don't want to punch out of it real fast. That's the other side of it. I could be in half a position at that point, be willing to add the other half down at 230 because I don't necessarily think we'll go below that. And if I'm wrong, I'm wrong, and I'm going to be wrong down to 228. So I could do a third, and a third. The more I talk through it, the more I'm talking myself into thirds at 232.5, let's say, as a starter. This is just one thought process of how you would enter a trade, assuming that another rally is coming into the next 6 to 8 weeks, which I still believe to be the case. Anything below 228, and I'm wrong, and something way, way different is developing, which is possible, not probable. I'm just telling you that I'm willing to step into the market down here at 232 and change, most likely tomorrow and or Monday. I'm also willing to step in at 230, and I would even be willing to step in at 228. Closes below those levels, and I would have to reevaluate, but that's the risk I'm willing to take as a swing trade, assuming that I could be wrong for a few days, but I will be right over the next coming weeks. And that's my swing trading thought process on getting long the S&P kind of right here, right now, over the next, let's say, day or two of trading. Just to wrap that up, whether I do thirds or halves, I don't really know now. I won't decide until I decide. I'm just letting you know the thought process. If you're a more conservative trader, you do thirds. If you're more of an aggressive trader, you do halves. If you're a gambler, you go all in, and you shouldn't do that. But I just need to mention that that's what gamblers do. They go all in, which is always the wrong thing. You might win some of the time, and that's actually promoting the wrong behavior, because you will lose more than you win by doing that and subjecting yourself to going all in at any point in time. That's not what a trader who trades as a business does. That's what a gambler's mentality does. And yes, you will win sometimes, but lose more than you win. The numbers prove that out. Let's move on off the soapbox to the IWM. We had a reversal in the IWM, which was the leading indication of the market going higher yesterday, okay? And today, it's the leading indication of the market going the other direction. And this is what happens. Sometimes the market doesn't give us a clear picture. And we talked about that last night. We had some indicators that were going one way and some the other way, and that's why we called them diverging indicators. And when we have diverging indicators, and we're kind of in the middle of a range, what we say is we just don't have enough data. We don't have enough information to make a decision to affect the trade one way or the other. We need more information. Today, the IWM being down 1.5% against the spider down 0.5%, triple the magnitude of downside in the IWM is meaningful, even though yesterday it was telling a different tale. This is more meaningful. It tells me there's more downside coming sooner than later. That's what this one picture is telling me in the IWM. When you look at the intraday activity, the IWM really was not able to get any meaningful rally going other than one over here in the, let's see, 2 o'clock time frame, and then it really collapsed down and had a poor close, making a bearish pattern into the close. But when you look at the hourly chart, okay, you can see here that this is consolidating sideways on an hourly basis. And the more times that we test these pivot lows, the less likely they are to remain as support levels, and they will break. And that's what's happening here now. Whether we go up or not first or come back down again remains to be seen. But these pivots are giving way, and we're going to come down to some lower levels. And 134.75 is really not that far away. And then ultimately we'll come down into this double bottom area at 134, which is $1 away on the IWM. Once those give way, you come down to this double bottom down here at 132.5. And at the same time, the spiders are scaling down. And that seems to be what is possibly developing. And I think a lot of it is going to depend on the market's reaction to the financials earnings in the morning. And it should get kind of wild out here. It could go in either direction. Obviously, we could have a reversal of today's activity and go to the upside. And by the way, in the spider, where would the upside resistance points be? Since we're talking about the upside, we might as well give both sides. Well, naturally, just from an eyeballs perspective and just from really a common sense perspective, if we did rally in the morning in the S&P, the first area of resistance is going to be the moving averages. So right where the 50-period moving average is, which is right now at 234.92. So we'll call it 235 to 235 and a quarter. That would be a natural area of resistance right out of the chute. If we did rally up tomorrow, that would be common. And then after that, the other level of resistance would be towards the top end of the range, 235.75, 235.85. You know, up in that end of the range. And when you pull back the curtain and you go over to the hourly chart, you can see here that, you know, if your first area of resistance would be basically where the market struggled today, that's natural, right here at 235 and change, up to 235 and a quarter. So you see it validated on the hourly chart. Look at all this chart consolidation before a breakdown, bearish pattern, broke down. So we'll come back to retest that area if we go higher, and that will be a natural resistance point. And then right after that would be the top end of the range where the market also consolidated before breaking down up here at 236, 235.75, up in that neighborhood. And that's the way the market would normally trade. And if you think about it, that's 15 to 17 or 18 handles on the S&P from where we are right now, and that would be a nice healthy up morning if it did happen. And that's where your resistance levels would naturally be on a positive reaction to bank earnings. And that's what I would be looking for as a trader on the positive side. On the negative side, I would be looking down to the lower levels that we discussed already in the spider, specifically down to the 232.5 area, give or take 50 cents. If we really did scale down. All right, I got off on a tangent, but I think those were good chart lessons, so why not? And then you look over at the VIX, and I did a little homework on the VIX, and you know, right here it's 16.5, 1675, so the number comes in at 1666. I don't love the sixes, but that's a normal garden variety 382 retrace. Or pardon me, 50% retrace from pivot high to pivot low. And then here's a 618, and this is just a midpoint. That's all this is. It's in between. So I have three numbers up here on the VIX, and I got to tell you, it's way extended. It's going to top out here at one of these three levels. This is the extreme. The red line is the extreme. I don't see it getting up there. It's just in case. So, you know, you have three solid up days. Maybe we have a fourth. Whenever we put in a doji candle, the VIX volatility index, the premium will come out of that. It will collapse back down in short order. It's just a matter of where this market wants to find a bottom. And it may go up, you know, a little bit higher. That's certainly possible. The market may go down to that 230 level on the spider ultimately that I was originally looking for. That is possible. If it does, you'll find the VIX up at 17 17.5, maybe even 18. At that point, you're selling the VIX up at those levels. That would be a high probability trade. So I just wanted to bring that to the forefront. And then when you look at the transports, just when I'm touting the bullish pattern of the transports, what happens? The bullish pattern begins to collapse. It's not technically off the table yet. It won't be technically off the table unless and until we close below 89.2390. But it's just ironic how that happens. There are no coincidences. I'm talking about how the transports fought the 20-period moving average yesterday to keep this bullish tight pattern in place. And then today we have a collapse down of almost 2%, 163 points in the transports. Of course we did. After all, why wouldn't we after I talked about it? So that's the way it works. So that's also, when you have the transports and the VIX, pardon me, not the VIX, the IWM, all pointing in the same direction on a heavy day, including, and not to exclude, the broker-dealer index down over 1%, all pointing to weakness in the market. That's all basically relative weakness altogether. Leading indicators all weak together to a decent magnitude has to be viewed as more weakness ahead. No divergences that I can see today. So when you see that, I got to figure there's more downside coming. So whether it's a quick shot in the morning or it's prolonged into next week, we'll see. But it's going to be predicated, I think, on the reaction to the bank earnings. So whatever the bank earnings are don't really matter, doesn't matter, pardon me. It doesn't really matter. It's just how the market perceives them. JP Morgan could make $9 billion, and if the market thought they should make $9.1 billion, they could send the stock down $2.50 in a flash. That's just the way the market works. We've all seen that thousands of times. It's over and over and over again, and it will never, ever end. Let's go over to gold. And so, also I took a poke around gold today, and, I just refined some stuff, and just quite interesting. We're at 1289.70 was my number, and we're at 1288 and change. And, gold was on a breakout. It was a bullish pattern. We talked about it dozens of times, and here we are. And there's probably more upside coming. And I put in 1312. It could be 1310. It could be 1307. It could be 1311. It's not really a refined number. It's a gap fill, and it's in the neighborhood of another number. So I'm just going to say in this neighborhood, we could get all the way up there. If we get a pretty decent sell-off in the stock market, and we talked over the last several sessions about the fact that even though I don't like correlations, sometimes they are worth talking about. And when you have a correlation or an inverse correlation, in this case the stock market and gold, you might as well run with it while it's working. And right now it's working. So what I'm saying is gold is going higher, the stock market is going lower. Gold has been the tell, as has the bond market, and we'll get to that later. So gold has been the tell, this bullish pattern consolidating for quite a period of time in this zone that was consolidating to get above this zone here, consolidating to get above this high. That's the way the market works. We came up to test the high and failed. Didn't have enough mustard. Only consolidated for like 3 days, right? Remember this? And I said, I don't think the gold market has enough mustard in the jar to get through that high. It's going to need to consolidate for a longer time. Who knows exactly how long, but longer than that. And we went back and forth, and we stayed in this upper range. And we consolidated right where this breakdown point was, back and forth, underneath this old high, and look what happens. And we got through it, and with a 1274.9 was only a way station because we consolidated here for a long time, and that gave us an easy pickings right through the 200-period moving average. We only stopped here one day, and we went right up to the next level that's been on the chart for months and months and months and months. We talked about this level months ago, long before gold ever began to make its move, and now we're going to talk about higher numbers of 1312, even 1345, not necessarily on this rally today or this point in time over the next few days if it continues. But ultimately, we could get up there. So that's what I see in the gold market. And what else you see is, remember that pattern we saw in silver. We saw a one-day breakdown, or a two-day really breakdown, and that was the fake out right back into the moving averages, test the breakout point, the green candle low, close above it. You know, it's easy in hindsight now, but how many times have I described this to you over and over again? We just keep seeing the same thing. I'm not suggesting that this was easy to trade. I'm not. I'm just saying that this is the way the market works. It tries to make as many people look like fools as much of the time. And in silver, it tried to fake out all the people that were buying up here, thinking this was a breakout pattern. They fake out as many as they can that sell, and then they whip it back the other way, reverse the market, and continue higher. And this is nothing other than bullish consolidation, building energy to get through this high here. Really the same as in gold. It's just interesting the way it works over and over and over again. They don't all look the same, but in the end, they all really do the same thing. They have to consolidate to get through an area to take the next level up to the next area of resistance. That's just the way the market works. By the way, what's the old high? The old high is 1854. Today's high, 1858. We pierce through it, back off of it. That's also the way the market works. But we've built enough energy here to get through this high. There could be another leg up to the 1894 level. That's really the next major level of resistance for silver. All right, let's move it along. And you know what? We're going to cover GDX tonight because I know a lot of traders like GDX. And with gold moving, I just want to take a peek and say, you know, should it be up more than 1.27%, 31 cents on GDX, with gold up again, you know, $15 today? And I think the answer is it should, but one of the reasons it's not, in my opinion, is it's not the same pattern, and it's basically going to run into resistance right here at the 200 period moving average, breakdown point, symmetrical move off the most recent bottom from here up to here. Here's your midpoint where you consolidated. Here's the second leg of this rally. So you have an up move, consolidation point, secondary up move into the 200 period moving average, into a big consolidation point. We're not going to get through there by consolidating for a couple of weeks down here. It's not going to happen. So this is going to stall out. And whether or not that's a tell for gold or not in the short run, you know, we could get up to 25, 25 and a quarter for certain, but you're going to run into resistance up here pretty soon, even if you have another 50, 75 cents on the upside. This is really a fade up at over 25 right here. On the daily chart, if we consolidate around 25, you know, for a week or two, that's different. Then we can go higher. But we should stall out right here and pull back a little bit. So I just want to bring that to the forefront for those of you that like to trade in GDX. Going over to the crude oil market, we flagged this one. Crude wasn't just going to walk through that area. What was the high? 53.76. What was this gap fill? 53.66. We talked about that last night. It wasn't just going to walk through there. Filled the gap, backed off, 52.82. Backed off of it. Pretty good amount. I mean, that's a nice little sell-off if you're shorting a gap fill for a trade, right? So is there more downside? Yeah, there's probably a little more downside, but it could consolidate here, build energy to go higher. So it's not necessarily a short here. It was a short scalp trade up at the gap fill area for a trade. And if you're trading multiple contracts, you know, one's in your pocket and you can ride one down with a trailing stop. That's the way you handle that trade. But other than that, you don't short it now. It's already had a pullback, and it could just go back and forth here for a week or two, and you don't want to be in a choppy crude oil market. It's not a lot of fun. So that's what we see in crude. We, you know, flag that was obviously going to run into resistance up there. We'll see if it puts in a pattern sideways or even comes into the moving averages, because could present a tradable opportunity. But right now it's doing exactly what we said it should and would do. Going over to the bond market, we have another breakout similar to the gold market. And you know what? In the bond market, we did sniff this out. We said the bond market participants are smarter than the stock market participants. The bond market was signaling higher prices. And with the bond market signaling higher prices, we discussed that the stock market could come under pressure. How high can bond prices go? Well, on this run here, I don't know if we can get there like right now within the next day or two, but anything's possible. 155.20 is possible, even 150. That's possible. Not probable, but possible. And we're pretty far extended right now, so we should stall out. But look what happened. Just take this into account, okay? This is a good chart lesson too. So you run up and you consolidate, and you run up and you consolidate, all right? And you consolidate because you tried this 3 times, okay? This area 3 times couldn't get you through. First time certainly wasn't even going to come close. But if you go back and forth here for about, 3 weeks, about 14 trading days in that neighborhood, 15 trading days in that zone, and I can make a case if you count the candles from the time it made the attempt, counting that as 1. This is 14 down here, and then you began to break out. So you consolidated for about 3 weeks, about 14 trading days, give or take. And so I find that interesting, and then you started breaking out, and what happened? Once you got above this high at 152.23 that we talked about numerous times for a long, long time, you closed above that yesterday, and look what happened. You had a breakout today. So that's an important number, and that's just the way charts work. This could have been any chart. It doesn't have to be bonds. It's a chart lesson on any chart. This is the way it works. I wouldn't consider any short play in the bond market until we got to at least 155, probably in between 155 and 155.20. But I don't want to be short bonds now. If you're long bonds, you let them go. And if you don't have a position, you watch like a spectator. And if they get up to 155.20 in the next day or two, that would be a shorting opportunity. If they consolidated in this range, then that's off the table. This is just a 48-hour deal, 48 hours worth of market activity up in that area. That would be a shorting opportunity the way I see it. And going over to the dollar had a nice drop today. And I put this trend line in. It's not a perfect trend line. I put it in, which probably looks more perfect than it is. It's not a perfect trend line. But the point I want to make is here's a high, a lower high, and a lower high. And I think what this is telling me, I suspect that I'm going to be right in that we're eventually going to come down to 97, give or take, in the dollar. And that's going to present a buying opportunity. So 3 lower highs, generally that third one will be rejected. And you had this, lower low here. So we'll see. The 200 period moving average can certainly act as a safety net, and this double bottom can certainly send the market back up. That's certainly a possibility. I'm not going to say it's not. I mean, we could just trade in this channel for a while also. Once parallel channels are formed, right? I didn't draw this. The market's essentially drawing this in. And it's not a perfect parallel channel because this didn't come down to the bottom. But what I can tell you is based on this pivot here, that if we did get down to this lower end of the channel, then this would provide a certain level of support. And that may come into the same level at the same point in time as 97. That's a possibility. Okay, and I didn't draw this in perfectly. I just drew a parallel line and said, hey, look, if at some point in time over the next several weeks, couple of months, the dollar comes into 97 and it coincides with the bottom end of this channel, that would certainly be something worth looking at for a reversal signal. And that's the way you use trend lines, you use time, and you use price all together to determine, do you have enough evidence where the odds are in your favor for a positive investment / trade, whatever you want to call it. And that's the way the market works. And we're going to leave it on that tonight. I got long-winded, but I think I gave some information that should be of value to some of you. So hopefully that's helpful. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.